Coming up on today's show, tech stocks and what it means for the AI trade going forward, Donald Trump's latest moves, where we stand with earnings as big tech is all set to report, and why this chart is the only chart you need to make money in this market. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were rattled on Monday after Chinese artificial intelligence company DeepSeek grabbed traders' attention and sent a shockwave to chip makers, infrastructure suppliers, and power stocks due to claims that their AI model uses cheaper chips and less data than American AI assistants, and the market was very red on this. Have a look at Nvidia, down 17%, AVGO down 17% as well, Oracle down 15.5%, and all of the AI trade, especially the infrastructure build out AI stocks, were really red. All of semiconductors was red, equipment manufacturers as well as hardware stocks really took it on the chin as well. Communications too, Microsoft deep in the red, Palantir down 6%. It was a brutal day for tech and AI focused stocks. Google was down 4.25%, but Meta was largely flat. Tesla down 3.5%, Amazon down 1%. The only mega cap name that was deep in the green was Apple, right here up 3.7%. Very ugly day. However, not necessarily in this part of software right here. Now, that part of the AI trade is holding up okay. Stocks like Salesforce, HubSpot, Workday, they were actually significantly higher, and that's because these companies fall into a basket of stocks that strategists have highlighted to be the next generation of the AI trade. Phase 2 AI, stocks that'll benefit from monetization. And in fact, if you look at DeepSeek and they use cheaper chips and less power and produce the same results, these stocks want to see that. That's literally just margin to them, and that is why these software AI stocks were up in a very big way. And what we also saw was a reallocation from stuff like Nvidia to the broader market. We saw financials was kind of mixed, but mostly on the green side. Asset management was quite red, but we saw green everywhere else. Get MasterCard, PayPal, insurance stocks. Healthcare was very green, one of the best performing sectors. Industrials was kind of mixed. Consumer defensives, very green. That's staples. We definitely did see a defensive trade take place here today. And then utilities were largely mixed as well, and we'll talk about why that is in a second. When you actually dive into the sector analysis chart, we see some very glaring things. Defensives at the top of the heat. XLP, staples, healthcare, and real estate were up 2.6, 2.04, and 0.86% today. Now that really goes to show the type of trade we had. There definitely was a lot of worry, especially when it came to the AI trade. And I think a large part of that was just visibility for these AI names and their earnings, particularly Nvidia, AVGO, Microsoft, Google. The market doesn't really like when you get uncertainty towards earnings. Markets will climb the wall of worry, but sell off on uncertainty. They hate uncertainty. We also did see financials gain, and XLC did gain as well on the back of Meta largely being flat, and then some of the communication names doing really well. That being said, names in the red was the XLY, the XLB, XLE, XLI, discretionary materials, energy, industrials, utilities was the second worst performing sector. And we also had tech right here, 5.22%. But if you dive into utilities more explicitly, if we go back here, you can see that there were actually some really green stocks, and there were also some very red stocks. So anything related to AI power demand, stuff like GE Vernova, CEG, and Vistra Energy were quite red, but the rest of utilities was actually very green. There's a defensive trade as well in the utility sector. Nonetheless, the SPY was down 1.7%, and what we saw was a very bifurcated market today. The market wanted nothing to do with growth, and what we saw was the value trade was actually up in a very big way across the factor and size segment. Large, mids, and small saw their value counterparts outperformed, particularly here in large cap value. We saw a 1.6% return versus a negative 3.85% return in the large cap growth segment. And that really goes to show that the market really did allocate to stuff like staples, to stuff like healthcare, to stuff like real estate versus, the growth counterparts, the AI trade. And it really goes to show that the market was really, really anxious, especially with these Nvidia earnings. Now, Nvidia at one point was down 18% on the day. And just to sum up the whole DeepSeek situation, right? Pretty much they released an AI model. They said it only cost them $6 million to build out. They used 50,000 Nvidia H100 chips, and they produced the same, if not better results than OpenAI's latest model, as well as Meta Llama's model and the Gemini model. And that really had the market questioning, what does this mean for Nvidia's earnings looking out? Are markets just going to spend 95% less money with Nvidia? Do they have their AI build out already in tune? And I think the market doesn't know the answers to that. And when the market doesn't know the answers, you're going to sell. And the leader of that pack is going to be Nvidia. But now, if you believe that Nvidia can do $5 in earnings per share this year, right? Assuming their earnings goes flawlessly this year and there's no interruptions, where the stock is trading at right now is simply just a 23 times multiple. You multiply by 23, you get 116. You actually get a little bit under, you get $115 earnings per share. So right now, Nvidia on this year's forward earnings is trading at the market's multiple, and this looks like great value. This stock should really be trading at a 30 multiple, right? And if you do apply a 30 multiple, Nvidia should really be trading at $150 at the end of the year. And this is material upside. That's assuming they hit $5 per share. And we really have to look at Nvidia's earnings revisions over the next couple of days to see where analysts peg it out and how they think this will affect Nvidia's overall earnings visibility. But here's some DeepSeek in action. I asked, who is the president of the USA? And they said, as of my last update in July 2024, the president of the United States was Joe Biden. So with this model, there's definitely some questions that need to be asked with regards to how good it actually is. Nonetheless, the market definitely sees this as a threat for Nvidia and everything else, and that is why tech stocks sold off. However, we had a very bifurcated day globally. China was actually up 2%. When the US markets were down 2%. South America was very, very green. Europe was mixed, mostly down. And India, very, very red. All in all, you were either a huge loser or a big winner today. There was no in between except for those invested in European stocks. Now, Apple today was up 3.47%. And unlike its big tech peers, Apple has refrained from allocating billions of dollars to AI CapEx spending, and that is why the stock was up 3.47%. But with regards to earnings today, we did have a big notable name. SoFi reported earnings. Now, they were down 11% when the financial market and the broader market was actually up about 0.8%. And they actually reported a double beat, right? They beat the top line, beat the bottom line, but I think the market actually hated their guidance. 2025 guidance was for 23 to 26% growth, and those EPS estimates were actually below the street's expectations. The street was actually wanting guidance from the upper end of 26, 27%, and it also didn't help that the market, stuff like the Nasdaq 100 was down today, and that just got absolutely hammered today. But great earnings, guidance was a little lackluster. We'll see how the stock pans out for the financial sector, but financials were actually pretty green today, so it doesn't look like the market was paying too much attention to SoFi's earnings. Now, another market mover today over the weekend was some of the trade war stuff. Now on the weekend, Donald Trump started deporting immigrants back to Colombia. One of their planes couldn't land, and Donald Trump went on a tirade. He said he was going to implement a whole range of measures, and 20 minutes later, I kid you not, 20 minutes later, Colombia backed down, accepted the deportees, and actually said, we will use some of our planes to bring over Colombian deportees. They didn't want anything to do with the tariffs and sanctions Donald Trump was going to put on them. And this really goes to show the president of the United States working for the American people. And on the back of this, we did see the dollar rise quite significantly. Another market mover today was actually some of the economic data. We got good economic data. Look at new home sales, beat expectations ever so slightly, and then month over month came in at 3.6% growth, and the forecast was for negative 3.5%. So the housing market showing some real strength since the Fed cut rates, and really what we are seeing is some strength in the housing market. We'll see if this continues. Maybe this is just an end of the year phenomenon. Nonetheless, we are seeing strength in the housing market, in home sales, last week's data, pending home sales as well. And we'll see if this continues as rates do come down. And all in all, guys, when you put it all together, longer term breadth metrics and market momentum metrics still look very good. We're still well above the 50% range in the 100, 150 and 200 moving average. Looking a little less so constructive here in the shorter term averages. The 20 days looking actually all right, but the 5-day not so much. And the 50-day continues to stay below that 50% mark. It actually hasn't recaptured it in the last week or so when the broader market has. So all in all, longer term, things look good. And I do think this is an opportunity to get long. However, I think you should get long in the broader market because that's what we really did see outperform today. And then looking at advances versus decliners, literal market breadth, we did actually see more stocks decline than advance, 3,500 decliners versus 2,700 advances. But let's hop on the charts. Now, looking at the market as a whole, you can see a very red day in large caps, the S&P 500, the NASDAQ 100, as well as the IWM small caps down in excess of 1%, with the NASDAQ 100 down 3.3%. The market is about 10 minutes away from closing. But look at the RSP, guys. The RSP, or the equal weighted S&P 500, only down 0.1%. Really goes to show we actually did see a little bit of a rotation from the large cap names into the broader market. If you actually look at value versus growth, growth was down 3.87%. Value was up 0.78%. And that just goes to show the duality of the market here today. Now, all in all, the market actually did sell off mid caps. They did sell off small caps. It was definitely a day for selling. What we really saw was actually less of a rotation, right? And just more of a general liquidation, especially out of these large cap names. The market just hating uncertainty. And that's really what this DeepSeek AI brought into the market, was just a little bit of uncertainty. And that's why we saw the move we did today. Even when it came to Trump's tariff threats, that isn't uncertainty. That really is just worry. And markets climb the wall of worry. They sell off on uncertainty. And with regards to all of that price action, we saw yields actually come down in a very big way. The 2-year, 10-year and 30-year yield all down in excess of 1.5%. The dollar was largely flat, but coming well off the 110 level it peaked at just a couple of weeks ago. Bonds gained, so there definitely was some form of a safe trade going on there, especially when you saw staples and healthcare, the best performing sectors. We really did see a defensive rotation. However, we didn't see that in gold or silver. Metals were down 1%, 1.24%, and crude down 2.16%, nat gas down 5%, very volatile. All in all, guys, a very, very red day. It definitely was a risk-off day today. And looking at the S&P 500, we did peak above the core resistance. Core resistance didn't move up. We saw this massive gap down and go, and now we're bouncing right off the gamma flip zone, guys. The second we get below here, we are in negative gamma. And what dealers do in negative gamma is that they sell into weakness, buy into strength, and you have quite a lot of volatility. Whereas in positive gamma, now we are still in positive gamma, dealers buy dips and sell rips, and you generally get upward moving price action towards the highs, unless you get uncertainty like we saw right now, in which case you do see major gaps. So all in all, I think if the S&P 500 goes ahead and actually holds this level where we are right now, the gamma flip level, if that is the case, we probably base around here and then make the next move higher to try and close this gap, maybe retake all-time highs. However, if we fall below this here tomorrow, that's going to be very, very brutal. And then our next target will be the 5860 level. So right now, our target is the 6100 level. That's simply because we are still in positive gamma and we have trade plan. Looking constructive, we are seeing buyers sort of come in a big way at the gamma flip zone. You'd expect them to come in there. And as long as we hold this, we are going to target upside, and this does look like a buying opportunity for the S&P 500, and I would say the RSP as well. Are the RSP looking very, very constructive, the best looking chart right now, relatively speaking, from the lows compared to what has happened in the last 24 hours. Now, the NASDAQ 100, we're in negative gamma, we're out of negative gamma, we're in negative gamma, we're in positive gamma right now. However, this is a huge gap, and the bears didn't just take us down on a gap. They sold the high highs of that gap as well. We gapped all the way down to here. We went all the way up, right? And we still are pretty much at or near the lows of the day. So it really goes to show the bear case and just the lack of buyers in this market. Some buyers trying to come in right now. We are seeing a little bit of a body to this wick, as you can see right here. Nonetheless, very, very ugly day, down 3%. Bears are the clear winners. Now, with the Nasdaq 100, what you really want to see is a close above this gamma flip zone and consolidation here. If you don't get a good amount of consolidation for us to move higher, we are definitely going down towards the 20,500 area. Now, I would refrain from buying dips in the Nasdaq 100, guys. If you are just going to look for it, look at something like the RSP, maybe look at the S&P 500, maybe get some of that broader market in your portfolio if you are going to go ahead and buy. And then the RTY coming off the core resistance and sort of kind of bouncing here at the gamma flip zone a little bit. The lows were pretty close to the gamma flip zone, but you know, we are sort of like in the middle between the core resistance and the gamma flip. And guys, you know, this all comes back to what we said at the end of last week on the weekend video. A lot of these indices were at the core resistance, and we actually have seen pullback from those levels. Now, yes, there was a news event. Nonetheless, on a technical basis, we probably would have seen roughly the same today off price action we saw last week. And that was with the Nasdaq 100 coming off the core resistance, as well as the S&P 500 coming off the core resistance. And that's exactly the type of trade we said to take. We said, you know, we were likely going to see downside into this week. I think we've pulled all of that downside forward in the S&P 500 and the RTY. I think we can see a little bit more downside in the Nasdaq 100. It just depends on how it consolidates, but we've probably pulled all of that downside forward. And I do think we probably see a material upside from here, particularly in the S&P 500 and small. So there was definitely some sectors and stocks acting very, very well today. I mean, look at the RSP, pretty much flat today. I mean, there's about 4 minutes till the market closes, and we could actually see a positive close for the RSP, relatively speaking. And yeah, all we're doing right now is building a base right here for the RSP. It's going to be a tight base, and then we'll see if the next move is up or down. But generally speaking, these bases need to be short, quick, and tight, and then make their next move. Great strength in the RSP. I like what I'm seeing. What I really want to see the RSP do is go ahead and take out that high, which was Friday's high. If we go ahead and do that, it opens up 184, 186, and 188 in the RSP 500 very, very quickly. Look, the RSP now flat, slightly positive on the day. You love to see that. So the broader market showing real strength, value showing real strength. I think you want to buy these dips in the S&P 500 as well as the RTY. Maybe hold off on the Nasdaq 100. We really need to see what Nvidia's earnings visibility looks like from these major banks. Once we get their reports and we can read their reports and say, hey, this is going to affect Nvidia in this amount, it's going to affect their revenue like this, or it's going to have no effect, then we can start looking at allocating to the Nasdaq 100. So stay away from some of these big tech names. Look, if you are going to buy any, I like Google, I like Meta, but until we actually get visibility on Nvidia's earnings, probably stay away from that. Look at the S&P 500 and look at the RTY right now, guys. They're your best bets, and I still think this is an opportunity to buy the dip. And guys, let's talk about sentiment. This is BOFA's bull bear indicator, and we saw a slight uptick in bullish sentiment over the last week. We moved from 3.8 to the 4 level here in BOFA's bull bear indicator. And while we did see a tick up in sentiment, we're still not in that overly euphoric bullish territory, which would mean we are in this part of the indicator, and that would be an indication to sell. We are still closer to the buy zone, as you can see right here. And this is probably telling us that in the equities we are holding right now, probably is time to just hold, have conviction, and let the market do its thing, because there is a lot of buttons the market can push to take us higher in the S&P 500. And this indicator says we can still see momentum in stuff like high frequency positioning, equity market breadth, equity and bond flows, as well as long only positioning can get ever more so bullish. In fact, the only very bullish sentiment indicator is credit market technicals, and we do know that spreads are extremely tight going back to as far as 07. So all in all, guys, expect prices to go higher, expect sentiment to get ever more so bullish, and hold the equities you have right now. And when we look at sentiment from where we are right now, we aren't exactly right here. we are probably closer to this area right here. But what we do see over the next couple of weeks and days into the middle of February is generally bullish momentum. And this is just on the back of a huge set of data and general seasonality going back to 1928. However, what is actually going to get us here? Now, the market does have a whole range of tailwinds. Corporate buybacks in the first 3 weeks of January as a percentage of the S&P 500 is some of the highest we've ever seen. Now, you might think, oh, we were lower than 2024, which was lower than 2023, which was lower than 2022. But you do have to understand that the S&P 500 is at all-time highs right here. Absolutely crazy. This is as a percentage of market cap. Market caps have literally never been higher. And to see this figure right here really goes to show that management teams believe stocks are not too expensive and they are deploying capital back to shareholders. Another very bullish tailwind is when we look at the number of M&A transactions again through the first 3 weeks of January, 48 compared to what we've seen in the last 2 years. Now, it's not nearly as bullish as we saw in other years, right? However, this is a step in the right direction coming off the Lena Khan administration we just had, which was almost against M&A as a whole. Another significant tailwind that can take us higher right now is earnings. Earnings is coming in very good. Nominally, we're seeing a 0.9% beat. 79% of companies are beating earnings expectations. We're seeing an 8.3% surprise index. And right now, earnings are sitting at 10.7% and 4.1% revenue, with the best sectors being financials, comm services, and technology. All see mid-teens to low 20s growth. You absolutely love to see that, with margins hanging in there as well. Now, there are a couple of headwinds that could definitely pose issues to the market. The number one is that the corporate buy-sell ratio is at the lowest it's ever been. In other words, corporate insiders are selling like never before. But when I was actually looking back at this, right, look at 2021. This was one of the lowest levels we ever saw. From 2001 into 2022, we actually saw the market rally significantly. So in other words, when we do hit these low levels right here, yes, it can be a headwind, it can be concerning, but it's not necessarily an indicator to sell. In some instances, it could be an indicator to buy. Another major headwind is valuation. I mean, the Nasdaq 100 trading at 29 times, 25 times for the Russell, and 22 times for the S&P 500. This is well above their average median range, and in some instances, the S&P 500 and the Nasdaq 100 are trading at top end of the range, some of the highest valuations we've seen ever. And if you are looking for value in this market, look to the equal weight, right, and the S&P 400 mid-caps. This is where you're going to find value. Now, the Russell 2000 does trade at 25 times due to the earnings expectations built in, and we are right now seeing 48% earnings growth so far for the fourth quarter. That's why it's trading at 25 times. And if these earnings do materialize and 2025 earnings materialize, the Russell 2000 is going to be cheap in hindsight. Nonetheless, if you want to find value, this is where you have to look. Otherwise, stocks generally look expensive, at least according to history. However, the macro looking very, very solid. Now, we got the latest growth projections from the IMF, and they see advanced economies increasing 1.9% in GDP growth. They see 2025, the global economy growing by 3.3% and 4.2% for emerging markets. Now breaking it down on a per country basis, you can see that the United States, 2.7% GDP growth, very, very strong. That's for 2025, then 2.1% for 2026. And guys, with growth figures like these, you want to be invested in the US market because it's simply the best out of all of the major economies. Look at the Euro area growing at 1% versus the US. So you want to be allocated to US stocks. And I think more specifically, the broader market, the equal weight and mid caps, well, small caps, if you can capture that alpha. Now, something for a long time on this channel that I've mentioned is that I think we're going to see inflation come down significantly on the back of shelter inflation. And I have more evidence proving that because base effects could play a big role in the upcoming CPI prints. The shelter component, which has a major impact on inflation readings, is facing much easier year-over-year comps from earlier 2024. This could suppress CPI for January and February 2025, making the CPI figure print lower than what the market actually expects. If this happens, bond markets might start pricing in these lower inflation expectations, potentially pushing bond yields down as early as February. And this is definitely something to watch. I think we're going to see shelter inflation come down in a very big way. CPI is going to come in a lot cooler than the market expects. That's going to be very, very positive for the market as a whole. Another great economic indicator I've been looking at is rail traffic, and it's official. If you are waiting to see front loading before these tariffs hit, here it is. Rail traffic is completely off the charts, or off the tracks, I should say, pun intended. And when you see front loading numbers like these, it's highly, highly unlikely you're going to get any form of economic weakness or recession, at least here in the first 6 to 9 months of 2025. We'll see how this pans out for the rest of 2024, but rail traffic looking really strong. Look at total traffic, 25.9%. And then on a year-to-date basis, up 9.1%. Absolutely crazy. The type of stuff you love to see. And this just sets us up for great Q1, Q2 GDP growth figures. Now, looking at earnings for the rest of the week, guys, Tuesday, tomorrow, this is a huge week, probably the biggest week of earnings we'll have this earnings season. Now, we kick things off tomorrow with Boeing, GM, Lockheed Martin, Royal Caribbean Group, RTX, and Synchrony, JetBlue as well. That's all before the open, big names. And after the close, we have Starbucks, SAP, Lending Club, Logitech, Stride, Nextracker, Chubb Insurance, as well as F5 and Stryker. So a very, very big day here on Tuesday. And then it just kicks off the rest of the week with some of the major mega cap names reporting, but we'll get to that as the week progresses. And then tomorrow, the only big data print we have is durable goods. And the consensus here is for 0.8. The forecast according to Trading Economics is 0.5. We'll see who is correct, but I think any figure inside this zone right here should be very, very good for markets, PMIs, manufacturing as a whole. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.